Hi, and welcome to the April Buy-to-Let Mortgage Market Update. My name is Richard Purnell from the Mortgage Home, and we are your buy-to-let mortgage experts. In this piece, I want to talk about interest rates. I want to talk about everything Bank of England and mortgages, of course. So let's get a bit of context. We are currently, where are we? We are at the point of recording 13th of April, and the Bank of England rate is now at 4.25%. Have we had 12 consecutive rate rises? I'm losing count. There won't be another rate rise this month. That, I guess, is some good news. However, here's my prediction. Where's my crystal ball? I would say that it's likely, so it's probable, highly probable even, to say that rates are going to go up the next time the committee meet, which is early May, and I suspect that will be 0.25%. So I think we're going to be up at 4.5 soon enough. Now, here's the thing. Depending on what the impact is on inflation, the experts, people who are paid far more than I am to figure these things out, are saying that inflation will tumble during 2023, particularly due to energy costs. Now, depending on how quick that kicks in, I think will determine whether the Bank of England are going to put rates up even further. So I think it's possible that rates are going to go up a second time around June or July. And if they do, I would suggest that it's going to be another 0.25%. So we might have another 0.5% of pain. And when I say pain, I'm talking to you guys who are on standard variable rate. Now, there's about 1 million people, million borrowers in the country. That's about 10% of all mortgage holders who, for whatever reason, are sat on standard variable rate. Now, if you are on SVR because you believe, and I'm going to say under the illusion that you're waiting for fixed rates to drop and you will then jump off your standard variable rate onto a lower fixed rate, I think you're under a misapprehension that that's going to happen. Rates have stabilized in 2023. So now is the time, I would say, to get off the fence, take some action, and now look at locking yourself into a fixed rate. If we think about those people who might even think that mortgage rates could even go up, because if we just look back at what I've said about the Bank of England rate, I do still come across many people who are linking the Bank of England rate with mortgage rates, and you've got to decouple that. So let me tell you why. If we go back to October, and I really hate to harp on about Liz Truss and that bloody debacle that she took us through that accelerated mortgage rate rises. But let's start with the Bank of England rate. In October, the Bank of England rate was 2.25%. And as you know, right now we're at 4.25%. So from October to April, Bank of England rate gone up 2%, almost doubled. If we go back to October, so it's after Liz and Crazy Kwarteng had released the budget and that kicked off the mortgage rate rises. In October, mortgage rates for a typical 5-year fixed was 5.6%. If we look today at the 5-year fixed rate, those same types of deals, they're down. They're at 4.4%. So we've got a Bank of England rate that's gone up in the last 6 months. Mortgage rates that, yes, they went up over the October to Christmas and into January, but they've since come down and they're now lower than they were in October. But as I've said already, and this is really the message I want to get across, it's important for you to know that rates have now stabilized. And this is reflected not just in my own view, but this is what's happening UK wide now. The bounce back has started. UK stats, which sadly I look at from time to time, as showing month-on-month increases. We're looking around a 10% month-on-month increase in both purchases and refinances in February, which on a national level is the latest figures we can view right now. But that demonstrates really it's not a blip. That's consistently month on month productivity sales volumes in this area increasing. Now, I want to also focus in then on one particular lender, because as I said a little earlier, the time for action is now if you've been sat on SVR rate and you're looking for those best deals. But one particular lender that came on my desk about a few weeks ago was Birmingham Midshires. And I know that there'll be lots and lots of you landlords out there that will have in your portfolio a BM Solutions, Birmingham Midshires type buy-to-let mortgage. And right now they are offering amazing product transfer rates, meaning for existing borrowers, the offering now to come off SVR. So if you've got one of those BM mortgages, I suspect you're on a 5.5%, 6.5% interest rate. You can get a significant reduction now by locking into a 2 to 5 year fixed rate with BM. However, if you ring BM up, they'll not speak to you. You have to go via a broker to get those offerings. So make a note here to speak to your broker to investigate that and see what you can be offered. So the overriding message today is start that refinance now. If you've come at the end of your deal, you're about to come, or you're within 6 months of coming to the end of the deal even, start that process today and see what can be offered. If you want to talk to our team about anything I've mentioned in this piece, there'll be a link to our online diary. Just click the link or cut and paste, jump on there and have a free review, and let's see if we can help you. Okay, in this piece, I really want to talk about my top tip for refinancing if you're a portfolio landlord. So who does this top tip, who is it for? Who's it going to benefit? Well, first of all, I want to talk about the time when you come to the end of your deal. So this is for people who have usually had a fixed rate. It's about to come to the end of that fixed rate period, and you're looking to refinance onto the next best deal. But so here are some of the conditions or the caveats. I'm only talking about you portfolio landlords where the buy-to-let mortgage is in personal name. So this does not apply if you've got a buy-to-let in limited company. The second thing is that I'm talking about you landlords where you've got 10 or more buy-to-lets. Now, let me explain why. So when you are looking to refinance your buy-to-let mortgage, the lenders you can approach tend to fall into one of two camps. You've got your high street banks and building societies. Now, this is where, generally speaking, the best rates sit. But as you probably know, for reasons we ain't going to get into, the high street banks and building societies do not like portfolio landlords. And they have explicitly within their rules that says that if the background properties, if the buy-to-lets you have in your portfolio exceed 4, certainly, but by the time you get to 10, then every single high street bank and building society will not want to consider an application for you. So therefore, your only option as a portfolio landlord with 10 or more properties is to go to the secondary specialist market. Your Aldermoors, your Precise, your Paragons, Kent, Fleece, Kensington. You get my point. But here's the thing. There's an exception. And it's the exception I want to talk about today. Now, the exception to the rule is, as I've got in my 4th bullet point, if you are borrowing on a pound for pound basis. So let me just briefly explain if that appears to be jargon to you. You're coming to the end of the deal. You owe £100,000 on your buy-to-let mortgage, and you are not looking to raise any more money. You're not looking to consolidate debts. You're not looking to raise any capital. You're not looking to access any of your equity. You simply want the best rate, the most competitive rate for you on the existing £100,000 borrowing. That is known as pound for pound borrowing. So this is the exception, that there are a small number of high street banks who will entertain an application from a landlord who has got more than 10 buy-to-lets, but only when they're doing pound for pound borrowing. Now, here's the thing why I'm really wanting to highlight it this morning, is that if you are using a mortgage consultant, a broker that does not deal in buy-to-lets on a regular basis, I'm going to lift the lid a little here. It's not a secret as such, but this is the process that us brokers go through to make our life a little bit easier. We use a sourcing system. So it's a database whereby we put your details into this database to do some of the heavy lifting for us. In other words, there's thousands and thousands of potential buy-to-let mortgages out there. So if we put into this sourcing system that you're looking to refinance your £100,000 buy-to-let mortgage, and we would say that you have 10 or more buy-to-lets in the background, the sourcing system is not clever enough to understand the exception to the rule. It goes off the general rule that you would not be eligible for the high street banks and building societies. Therefore, the only list of lenders it shows are the secondary specialist market lenders. And if you're a broker that is not that finely tuned into the rules of buy-to-let lending, you will look at this list, and therefore that broker will be only recommending products to you from the secondary mortgage market, and will miss out on this exception to the rule that I've just highlighted. And as I said, not only are there slightly better rates generally found with the high street bank, but what I also tend to see is that the high street guys will offer other benefits. They will nearly always offer free valuation. They will nearly always offer free solicitors. And that's unusual to get in the specialist secondary market. You're quite often not only paying slightly more on the rate, but it's not unusual to having to pay a valuation fee, or at least the solicitor's fees. So it's my top tip today to speak to a specialist broker when it comes to you landlords where you've got 10 or more properties, because otherwise you may well be missing out. If you want to have a chat with the team on any of this, there'll be a link to our online diary system. Book yourself in, have a chat, see whether you might be eligible for one of these high street products, and get saving some money. Here today, I also want to talk about my top tip for raising finance when you are currently tied in. It does get me frustrated on a regular basis where I'm talking to my clients who think, well, I'm tied into a mortgage for another, let's say, year. My fixed deal doesn't end until April 2024. Therefore, I cannot get out of that deal. I cannot access my equity. Now, that's fine if you're in no hurry, if things are just ticking over and you're happy to wait another year. But what if? What if you've got that deal of the century that's just come on your table? You've got the opportunity to buy a property at a significant discount, or you've got an opportunity to buy a property where the rate of return or the yield is exceptionally high, and you really, really don't want to miss out. But you're tied in. You don't have the savings to put down as deposit. You need to access that equity to be able to buy this property. What are you going to do? Well, you can't wait, can you? So here's some options. The blindingly obvious one, well, is it worth paying the redemption penalty? Yes, you can. You look at your terms of your mortgage offer, you might be surprised. The penalty might be lower than you think. It's not unusual. Let's, for example, take a 5-year fixed rate. It's not unusual for those penalties to reduce year on year. So if you happen to be in year 4 or indeed year 5 of your 5-year fixed deal, those penalties could be quite modest. Could be a pleasant-ish surprise. But you have to, either way, I would really challenge you to say, look, don't just think of the penalty and that, oh, I'm paying £1,000, I'm paying £2,000 as a penalty. And in principle, I refuse to do that because why should I pay the banks that money? That could be cutting your nose off here to spite your face. Look at it in context, of course, of what that discount is that you're getting. Or if you think it is an exceptionally high yield, an exceptionally high return on investment, then look at it in context of the additional benefit you're going to be getting. And if it's going to cost you £2,000 to get out of your penalty, but you're going to get an extra 5 or 10 or 20 grand discount on the purchase, or year on year, that additional yield you're going to be putting in your pocket means that that will offset that penalty, then why wouldn't you do it? That's the first thing. But there might be some cheaper options for you. The next one is further advances. Again, there'll be some people I'm talking to today that have never come across a further advance for whatever reason. So let me explain what that is. So this is like a mini mortgage, and it sits alongside but independent to your main mortgage. And you approach your existing bank or lender to apply for a further advance. Now, not every lender offers that facility, but I would say the vast majority do. So there's a good chance that your lender will have this facility. But as I said, you have to apply. It's not a gimme. You have to jump through hoops. There will be credit checks. You will have to show income and outgoing information. There will be assessments of what the rent is and whether that will service the extra borrowing that you're looking for. So yeah, there's lots of hoops to jump through. But if you jump through those hoops successfully, I can tell you that it's highly likely that that's where the lowest cost of extra borrowing will be in a further advance. In all the things that I'm talking about here, that's the one that's likely to be the most cost effective for you. You can either do this yourself, or again, as brokers, it's something that we do all the time, so we can look into whether you might be eligible for that. Now, what if that your lender doesn't offer further advances? What if, yes, they do, but they're not going to give you the extra borrowing you want, so you don't have enough for that deposit for that next purchase? What are you going to do? Well, you can then move on to something called a second charge. Now, again, this is very similar to a further advance, but instead of approaching your existing lender for this mini extra mortgage, you're approaching an independent lender for that extra borrowing. Now, as the name second charge more than suggests, let me just talk about main mortgages. They're classed as a first charge. So a second charge, as the name suggests, sits behind a first charge. So it's seen as a higher risk to these lenders where they're offering second charges, because if the worst happens and there's a repossession and everybody wants their money back, then your main provider, your main lender that has the first charge, has first dibs once that property is sold at reimbursing themselves what they're owed. And only if there's funds left over does the second charge lender then get a chance at reimbursing themselves. And that's why it's seen as a higher risk, and therefore the interest rates are highly likely to be higher with a second charge lender, but still might be competitive, still might mean that it makes financial sense for you to take a second charge loan, because, as I said earlier, the discount or indeed the return, that investment outweighs the costs of borrowing. So again, speak to your broker about second charge options. The last one, probably the least known, and I suspect will take most people out of their comfort zones because it's unusual, essentially to approach a private individual, usually, to work on a joint venture basis. Now, before you jump to the misunderstanding of what I mean by joint venture, because under that broad definition, there is actually a number of permutations of what a joint venture might mean. Now, I am not meaning going into a 50-50 partnership with someone, which means you're giving away half of the equity, half the profits of this next purchase that you're going to do. I'm talking about a far more simplified approach and something that's called the guaranteed interest model. And that's simply borrowing money from an investor, and you're going to pay them a return in interest on the amount that you've borrowed. It's a simple loan. So trust me that this happens on quite a regular basis. You just need to understand how it works and know how and who to approach who might be interested in investing in you. If they're earning 1-2% on their funds in a savings account, and you could offer them double or treble that as a return, then wouldn't that be a win-win for everybody? It could also be done on a second charge basis, so that investor might put a charge secured against your property or properties, so there's an extra comfort blanket for that investor. So that's something you might be able to offer as well. But what I want to just get across this morning is the number of options that are available when you're wanting to raise finance when you're tied in. Don't naively think that you've just got to wait until your deal ends before you can access that equity. So if any of that is of use to you, if you want to explore that a little bit more, get into the detail of that, whether that's something that might be useful for you, then please get in touch, book onto the online diary system, have a chat with the team, and let's see if we can help. In this piece, I want to talk about deposits from investor finance. I've talked about it previously. This, as a recap, is a scenario whereby you are borrowing money from a third party and they're not blood relatives. They're in it from a commercial basis. They want a return on that investment. Then the usual rule, I'm generalizing here, but the usual rule is that the lender, the main lender, if you're getting a mortgage on that property, will want that investor to be a party to the mortgage. There are exceptions to this rule. I don't have time to go into it right now, but generally speaking, they want that investor to be a party to the mortgage. So unless you can find that exception, the only way forward is to buy it in cash. But today I want to talk about a potential way forward whereby your investor, the lender's happy for that investor to provide the deposit for your purchase and then do not want to be a party to the mortgage. So what I've talked about previously is in context of bridging finance. And we're now getting more confident that we've got lenders who are happy to bring investor finance in onto the table as deposits, and that investor can stay in the sidelines. They don't need to get dragged into being a party to the mortgage, and that's looking great. What I want to move on to is exploring that process, that system, that mechanism, but on main mortgages, on buy-to-lets, HMOs, holiday lets. That's where we want to road test it. We've spoken to a whole range of lenders, and we've got now a list, I think, of over 10 lenders who are saying that they were prepared to consider funds from third-party investors, but we haven't road tested it yet. And that's the acid test, isn't it? So I'm really want to invite anyone that's listening today who's thinking about working with joint venture investors to purchase a property, not on bridging, but on traditional long-term mortgages. And we want to then trial that, road test it, to see if those lenders are actually going to do what they say they're going to do, because then that really does open up many more opportunities for you guys as landlords to buy more properties with third-party finance and for them not to be dragged into being a party to the mortgage. So if that is something that you're considering doing, just want to understand it a little bit more, again, just book an appointment. We'll have a chat with you, tell you how it works, how we need to be setting it up, and let's get this going. And hopefully it's going to be great news for you guys as well as us, and hopefully other clients of ours. In this piece, I want to talk about insurance. I do raise this on a regular basis, but today I want to talk about whether your policy is fit for purpose. So here's my first question. Here's the thing. Do you even know what cover you've got? When did you last even, do you even know where it is? Where is that policy? Have you got it out? Have you dusted it off? Do you know how much it's covering you for? Do you know whether it includes critical illness or not? Do you know how long the term is? When does it actually end? And when did you last review it? You should be reviewing it, in my opinion, every couple of years. And why? Because life happens. Life events will get it. I'm going to say get in the way. That's probably not the right phrase. But life events do happen, and therefore they change your situation. They change your scenario. You may have gone from a single to a married couple. You may have gone from a married couple to having kids. You may have moved house. You may have larger or smaller mortgages. You may have other commitments. Your salary, your income situations change. All these have an impact on the type and amount of life insurance that you need to be fit for purpose and cover you for when that worst thing happens. And if you review it, you never know, it might turn out that you're actually overinsured. Can you imagine then that you can actually reduce your policy and maybe save some premiums? Or worse, you're actually underinsured. So when that bad thing really does happen and you dust that policy off, it's only then you realize that you've actually not got enough to cover the financial challenge that you're now finding that you and your family are in. When you do review that policy, is it in trust? I don't have time to explain what trusts are today, but take it from me that trusts are an amazing legal framework for your life insurance to sit in that could potentially save you thousands, tens of thousands of pounds in inheritance tax. It's very either cheap or even free to put in place. So have a look at your policy. Does it even mention that it's in trust? Is there a complementary document that says I am a trust document? If there's nothing of that around, it might be that it's not in trust, and therefore speak to the team about whether it's appropriate you put it in trust. You can put existing policies in trust quite often, but review it and see whether that is something that's appropriate for you. And the final question I want to pose back to you is, does this life policy actually pay the bills? Now, here's the question I want you to walk through. I see that when people have got life insurance, the thing that it always is put in place to do is to pay the residential mortgage off. That's the starting point. But here's the question I want to ask you. Is that enough? What if, one, you're a single person, so now if you're not here or you're unable to work, so your income has disappeared, or if you are a couple and the main wage earner's income has now disappeared, even if the mortgage is paid off, can you afford to live in the house? Can you afford, on whatever the residual income that's going to come into the family home, is there enough to maintain the lifestyle and pay the bills? Because if not, then you're selling that house anyway, which is not the point. The whole point is of these policies is so that you can keep the house over the family's head for as long as they need it. And if you've still got to sell that property, even if the mortgage is paid off because you can't afford the bills with the reduced income, then you need to think about tweaking that policy and either upping the cover so that there's enough money coming in to not only pay the mortgage off, but to ensure that you can maintain the family's lifestyles until such times as that maybe you want to downsize. Perhaps once kids are independent and they've left home, that might be a point at which you may not need that extra cover. So if you're thinking that that might be you, or you can't make sense of your policy and you just want to have a chat, no obligation. We do not charge any fees for our insurance advice. So speak to the team. We're independent in this area, and we'd be more than happy to give you our view on your situation. If you do want to book an appointment, here is a link to our online diary system. Number for the office. And by the way, right now, our appointment system is really booked up. We're absolutely inundated as the market is opening up again and as landlords are coming back and making decisions. So right now in mid-April, we are booking up to about 3 weeks in advance, which is not ideal for everyone. I get that, and I do apologize. However, if you have something of an urgent nature, ring the office. See if we can get you booked in a little bit sooner. And we'll do our absolute utmost to do that. And just finally, brief list of all the services that we offer. As you can see here, I'm not going to go through them all, but that's the sort of services, our bread and butter products that we advise on. And if it's something that you want to have a chat about, then, as I said, get yourself booked on. Let's have a chat and let's see if we can help.